We have this ebb and flow, the upswing and the downswing in free market-oriented economies. Look, it's the best way to organize an economy.
Right.
The Achilles heel is it has a cycle. So when you approach these turning points, what's the best tool to understand the risk? And we have found, and this is over 3 generations now, so we've been testing this, that a leading indicator approach where it kind of flags the risk of a turn is a good complement to the econometric model approach, which is really good in between the turn.
And the key thing there that's religion, folks, in the business of not losing money is a good complement. Did you catch the higher economic growth of the last 3, 4, 5 quarters?
Well, first and foremost, in 2020, we said it was going to be a short, nasty recession, and then we would be off to the races. So it's hard to remember, but there was a lot of hand-wringing in 2020 and 2021, and we were looking straight up. Now, the cycle indicators turned down sharply. So in 22 into 23, the cyclical impulse was very much to the downside. We actually had 2 negative quarters of GDP, but that's not a recession. I'm sorry. You have to have negative jobs growth. And so we did not have a recession in 22, 23, even though the cycle indicators came down hard. The reason is, as Tom just alluded, this backwash of COVID. There's 2 key pieces that we're dealing with even today. The backwash is still here. One is that you have a huge constraint, a generational constraint on the labor market. So under the Trump administration, you had about 4 years of very low, if nothing, on legal immigration. That knocks out several million people from the labor force. Post-COVID, a lot of people didn't come back. That knocks out millions more. On top of a highly constrained labor market, we put $7 trillion. Remember Senator Dirksen? He used to say $1 billion here, $1 billion there. That's a lot of money. Now we're talking trillions here and trillions there on top of a tight labor market. Very hard for jobs to go negative. So much foam on the runway. Hard to have a recession. Now, let's get to today. Leading indicators are actually firming on growth. They're starting to actually firm a bit. The other thing I want to get on the table is there's a global industrial upturn. That's not country specific. That's around the world. The manufacturing floors are getting a grip. And then separate cycles, because you alluded to Greenspan, there's an inflation cycle we have to contend to. It's different than growth, and that's moving up.
So, I mean, again, that is probably one of the key issues for this Federal Reserve as they think about inflation. How does inflation factor into this? And is there a reasonable scenario where this Fed doesn't have to cut rates?
Yeah. The short answer is yes. Okay. There's so we use these. There's the target, which is CPI inflation or PCE deflator or all these things, and they define the cycle, and we can say there was upswings and downswings. We're in a downswing for the most part. But there's a lot of signs that some of the coincident data is bottoming. And the reason I'm suspicious about that is because of the leading indicators of inflation. Internationally, they've turned up. In the U.S., we're the one holdout where instead of turning up, our future inflation gauge has been flat for over a year. So we really were prepared for the sticky or higher for longer or whatever has been going on. And now, with the knowledge that international inflation cycles are largely synchronized, we're really suspicious that the U.S. could go up.